Welcome to our webinar on New Jersey's net deferred tax impact deduction. My name is David Gutowski, and I'm joined here remotely by Matt Setzer. We're both lawyers with the state tax group of Reed Smith, which has about 40 lawyers across the country, including a dozen of us who are licensed to practice in New Jersey. Today's webinar is part of a series of webinars that we've conducted on New Jersey's shift from separate company reporting to combined reporting. And over the next 15 minutes or so, we're going to attempt to try to demystify some of the confusion that surrounds Form DT1, which is the form the taxpayers must complete in order to qualify for a net deferred tax impact deduction. So part of the problem, part of the confusion related to DT1, we think, stems from the fact that ASC 740, which details how companies need to account for their income taxes, including the deferred income taxes, there's really very little guidance in there about state income taxes. But the general framework is this. Companies need to identify their temporary differences and assign them either as deferred liabilities or deferred assets. And then they need to apply an applicable tax rate to those temporary items for the periods in which they reverse. Now, for state income taxes, that applicable tax rate includes not just the statutory rate, but also apportionment percentage. And if there's a change in law, ASC 740 provides that you have to account for that change, not in the year when the change gets applied to a particular tax year, but upon enactment of the law or adoption by the legislature. Companies are also required to account for any valuation allowances. And then finally, the year-over-year differences in the deferred assets and liabilities is computed, and that difference is added to their current tax expense to come up with their overall tax expense. Now, against this framework, Matt, can you take us through New Jersey's main combination provisions and how the division has been applying its policy with respect to the net deferred tax impact deduction?
So in July 1st of 2018, New Jersey's legislature enacted combined reporting. And with that law, there was both changes for the computation of the tax base, combined reporting, as well as the sourcing of services, market sourcing. So you have a shift from separate company reporting to combined reporting, and a shift for sourcing of sales for services from cost of performance to market sourcing. What happens with combined reporting in New Jersey? Well, it applies to the 2019 tax year for privilege periods ending on or after July 31st, 2019. You have the same effective date when it shall apply for market sourcing for services. You get the group composition of Water's Edge, affiliated group, or your worldwide group, depending on which election you make. And then you have some other division policies that come out of that. For example, in Technical Bulletin 86, the division essentially gets rid of 86272 protection for companies. With the change to combined reporting and market sourcing, the legislature also enacted a surtax for the 2018 and 2019 privilege periods of 2.5%, and then for the 2020 and 2021 privilege periods of 1.5%. And with the combined reporting change, you also had what is enacted as a net deferred impact deduction. What that net deferred impact deduction is supposed to do is get rid of any negative impact that the legislature's change from separate company reporting to combined reporting has on publicly traded companies. So if you have a net deferred tax liability that increases as a result of the change to combined reporting, a net deferred tax asset that decreases as a result of combined reporting, or an overall shift from a net deferred tax asset to a net deferred tax liability, then you're entitled to a deduction under this statutory provision. But what you must do to be entitled to that deduction is file a form with the division by July 1st of this year. So a limited time and bandwidth on when to file the form at this point. You have basically a week to prepare and file that form. So what we want to do today is really lay out some practicalities of what you should consider before filing that form.
Yeah, and I guess as far as the the form itself, there is some guidance that the division has released in the form of a tax bulletin. That's Tax Bulletin 96, and so it's worth a read. And importantly, the amount of the deduction that you ultimately, hopefully, will get to take is capped by the amount you put on your form. So you need to pay careful attention to this form, even though it's a short one-pager. What you put on that form is going to be with you for the next 15 years as this deduction goes into effect. So Matt, what's the division's policy with respect to Form DT1? If you're following the division's guidance, how should you prepare each line of the form?
Sure. So for purposes of the form, line 1 is supposed to represent the combined group's net deferred tax assets or net deferred tax liabilities as of the calendar year prior to the privilege period ending before July 31st, 2019. So for calendar year taxpayers, this is 2018 calendar year. And you prepare that line without taking into account the effect of combined reporting. Then line 2, you look at the same calendar year, so calendar year 2018 for calendar year taxpayers, and you prepare that line, your group net DTA or net DTL, with respect to the effect of how combined reporting has affected your group. And
so line 2 is going to be, so line 2 is going to be consistent with, how you would prepare, your financial statements under GAAP.
That's definitely the division's view. And then the delta between those two lines would be line 3, and that is the deduction that you're entitled to take. Essentially, we'll go through a gross up for the calculation, but that's the base amount of the deduction that you are entitled to take.
A quick clarification and correction. After our video first aired, the division let us know that its policy regarding Form DT1 is that market sourcing shouldn't be reflected in either lines 1 or lines 2 of the form. We'll explain why we disagree with the division's policy later on, but for now, we just want to clarify the division's current policy.
And the rest of the form is pretty much computational, but there's some items on that form that we want to point out. So line 3 represents that base of the deduction. Then on line 4A, what the division says is you divide that base by the applicable tax rate of the combined group, and that applicable tax rate includes the surtax. So instead of dividing by the statutory rate of 9%, you would divide by 11.5%, and that's part of how you gross up your deduction to get to the yearly amount that you are entitled to take on your form, on your return. And then after that gross up by the tax rate, you then divide by apportionment in your group's apportionment. After dividing by your group's apportionment, you divide that total amount by 10, and that is the yearly deduction that you are entitled to take starting in 2023 and running through 10 calendar years or 10 tax years until you use up the deduction.
Okay, so that's the division's policy regarding completing DT1. We're going to provide you with an alternative view to consider. The first step, of course, same way you want to compute the impact of combined reporting on your deferred tax assets and liabilities. But here's where we start to diverge with the division. Line 1 of Form DT1 is your baseline. That's what your deferred tax assets or liabilities look like without regard to combination. That's what you're comparing your deferred tax assets and liabilities with combination to come up with that difference to compute your deduction. But the division's policy is that you want to compute that baseline as of December 31st of 2018. And we're not so sure that that's consistent with the plain language of the statute. Under the plain language of the statute, you can make that computation as of the effective date of the legislation, which was July 1st of 2018. Even though combination didn't go into effect for calendar year taxpayers until 2019, the law was adopted on July 1st of 2018, and not only consistent with the plain language of the statute, but under ASC 740, that enactment date, July 1st, is really when you need to account for that change in law. So what this means is taxpayers really have an option. They can use July 1st or December 31st, 2018 to compute their deferred tax assets and liabilities for purposes of the deduction computation. This could have a material impact on certain taxpayers if there's a disposal of assets or a merger or an acquisition that changes your deferred tax assets or liabilities. It could impact your deduction accordingly. So if you have some sort of material event in the last half of 2018, you may want to try computing the deduction using both dates and see which one provides the better result, and then either go with the division's policy or the plain language of the statute. Another place where we diverge from the division's policy is how you compute that baseline. The division's position is the deduction only reflects the specific impact related to combination. But the statute's really a little more broad than that. It talks about what's the impact of the unitary reporting requirements under a number of sections in the legislation. The sections that are referenced include not just the specific combination provisions, but also the surtax and apportionment. So if you're trying to look at the impact of the law as a whole, you would want to compare not just the impact of specifically combination, but also the surtax and apportionment. And in practice, it can be hard to separate out the impact on your deferreds from combination versus the difference in market sourcing. So how we see it is, under the plain language of the statute, the baseline would really be your deferred tax assets and liabilities without regard to any of the changes in the 2018 law. Essentially take your 2017 deferred assets and liabilities and roll them forward a year as if there had been no new legislation in New Jersey enacted in 2018. And that would be the baseline that you would compare against line 2, which is, what actually happened and taking into account combination, market sourcing, the surtax, really how you would compute your deferreds in accordance with GAAP, and that is how you would then compute the delta between those two numbers, the impact of combination, but really all the things that came along with combination as part of this calculation. So you take that impact in your deferreds, and then you need to compute the value of your annual deduction. And so here's another place where we diverge with the division. The division says that you gross up, the difference in your deferreds by the New Jersey tax rate, including the surtax, compute your deduction. And we disagree with that based on the plain language and also based just on what the intent of the legislature here was. The plain language says that you gross up by the statutory tax rate, 9%. It doesn't reference the surtax for purposes of this calculation, nor should it, because the intent of the legislature was essentially to offset the impact of the combination provisions for financial statement purposes. And if you were to divide by 11.5%, you're going to get less than a full offset. And the reason for that is because when the deduction actually goes into effect in 2023, the tax rate is going to be 9%, not 11.5%. So don't shortchange yourself. Disregard what it says in the form and use the 9% way to gross up your difference in your deferreds. That's going to give you a 25% greater deduction than if you simply follow the form mechanically. As far as the rest of the form, we have no difference of opinion with that. You simply gross up again by the apportionment percentage, and then you allocate that out over 10 years in order to get your annual deduction. So let's wrap it up with some concluding thoughts. First, it's not clear that this deduction ever is going to come into effect, whether it's ever going to materialize. New Jersey's in a desperate situation now because of the pandemic. Its budget shortfall keeps climbing, and there's pending legislation that would delay the onset of the deduction until there's some sort of financial fiscal evaluation conducted. And as we've seen with other states that have done this, they tend to keep kicking the deduction down the road. So it's likely that New Jersey will do the same. But that doesn't mean you shouldn't go through the process of preparing the form. It's a fairly simple form, only a few lines in it. You might as well fill it out and see if this ever comes to pass. Now, if you didn't take into account combination preparing your financial statements, there's some language on the form that suggests you're out of luck, that you're somehow precluded from filling out the Form DT1 now. We disagree with that. There's nothing in the legislation or in the statute that says you're precluded from filling out the Form DT1 or qualifying for the deduction if at the time of enactment you didn't think that there was a material enough change to warrant any sort of reporting for financial statement purposes. We really view the DT1 process as a fresh start. So if you didn't pay attention to combined reporting for financial statement purposes, that doesn't preclude you from looking at it now. One important thing in the legislation to remember is there's no adjustment for subsequent events. So what you put on this form locks you in, and you really want to put your best foot forward, because there's no opportunity to increase your deduction later. You can always ratchet it down, but you can increase it. So you really want to take the best position that you can, that's supported by the statute, the plain language. This is not the time to be overly conservative, because you can't amend this form. It's set in stone. So it's worth the time to do it now and do it right. So that's all we have for today, and I hope this was helpful. If you need a copy of our survival guide, feel free to reach out to us. If you have any questions, feel free to do the same. Thank you.